You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Something that also is helping equities move higher here are airlines. You got Delta has been up for the last, United, I should say, has been up for the last few days since it reported. You also had Southwest, American Airlines, all kind of beating on earnings. The overall airline passenger index is also doing quite well. Paul, I thought no one was traveling anymore.
I don't know.
I mean, he did, but he's a late bloomer, so there's that. Joining us now is George Ferguson. He's a Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. George, I thought we were going to be looking at 2024 weakness because everyone spent their money and they're done traveling. What is happening with airline earnings right now?
I think a lot of it is being driven, frankly, by guidance. Well, some of the, some of the profit reports might be coming out better than people expected. When I look at yields this morning, we got American, Alaska, and Southwest. Yields were down in the domestic business on all three. Alaska yields were down 6 or 7%. American yields down similar number. Southwest really just let load factor fade away into the 70s and took a yield down sort of 2%. So to me, they're guiding to better results as next year as we get into 1Q doesn't look great, but as we get past 1Q, the overall guidance for the year looks a bit better. So airlines, I think things are going to firm as they get into next year, but I don't think it looks like a healthy market at all from the numbers I'm seeing in Q4.
So it's interesting, George. Give us a sense of where we are just in terms of air travel. Have we established a new post-pandemic normality in terms of where leisure traffic is and where business traffic is? Do we kind of know how that market looks?
So comments from United were that business traffic wasn't back to 2019 levels. They said they saw hopeful signs in 1Q. So as near as we can tell, from some of these results, business hasn't come back fully. Is this the new normal? I would guess it is, right? Because we're I don't know when the pandemic actually sort of ended, but we're probably a year and a half past. And I would expect most of, normality to have returned to our lives. So it seems like we still have some level of deficit on pre-pandemic business travel, but leisure travel has definitely exceeded that. I think the airlines have just sold the capacity they would have sold to the businesses into the leisure side. And I think that's making the fares softer.
So you say that the quarter didn't look that great, first quarter looks soft. I get that. But then you said that after Q1, things start to look a little better. What's going to look a little better? Is it business travel? Is it we just keep doing vacation stuff? We do it domestically rather than internationally? Or is it still across the board?
I said that after Q1, the airlines think it's going to look better. I don't see it, right? I think the big leisure bounce back was last year, 2023. And I think that you could see softer domestic yields all through the year. But, we had Scott Kirby at United Airlines earning earlier in the week, and he's telling us how, he's getting traction from premium products, and that's going to help him drive better profitability through next year. I mean, companies like Alaska, they have premium product, but I think they're roughly the same amount, unlike United that's adding it. Southwest has no premium product. So there's a lot of other airlines that have no premium product, and I think they're going to be fighting for the base leisure traveler. I think it's going to be difficult. But
George,
again, it's the airlines that they see it coming. Sorry.
George, you're out in Los Angeles, the Aerospace Supply Chain Conference. How is the supply chain for the airline industry? Can they get the planes they need?
That's rough. So we saw the news on Boeing today, or I guess late last night from the FAA about not allowing them to increase. The discussion at the Aerospace Supplier Conference is all about labor, and labor.
Wow.
There's been a lot of turnover. There's a lot of turnover in the industry. The backfill needs to be trained. They're not fully trained. They're not efficient. And there's still people having a hard time finding labor. Mm-hmm. And so the U.S. aerospace industry is in pretty tough straits, I think. I think young kids, a lot of the discussion here is that young kids, young professionals don't want to come to this industry. They'd rather work for Amazon. They'd rather work for Google than go to work in the aerospace industry. And so they're having a real hard time backfilling and training and keeping people in the industry.
So to that point, what happens if Boeing isn't allowed to produce the plane that the FAA said? I can't even keep track, to be honest with you, but if they can't produce it, what happens to those that have ordered it?
Okay, so I mean, right now what the FAA said is that Boeing can't increase production, right? So
Okay,
they're already
increase.
of the MAX. They're already building. They were building about 31 a month last year. They were supposed to rate break to about 38 a month at the end of the year. The question is, have they? So will the FAA let them continue at 38? And then, as I understand it, the FAA is going to inspect their manufacturing processes because they're quite concerned, obviously, after the Alaska incident, to make sure it's stable, make sure that Boeing can build aircraft safely. So my guess is you got something that's going to last part of this quarter. I mean, there's only so many sites they can really inspect, right? You've got a lot of inspection down in Wichita, a lot of inspection up in Renton, Washington. Those are the two main factories. The FAA could go deeper and do some of the other suppliers, which they probably will, but there's not a lot of sites to inspect. My guess is that deliveries for customers that expected airplanes in 2024 could get pushed out, probably will get pushed out maybe into 2025. Could be customers, core customers like United, Southwest, Ryanair, Alaska Airlines. They've been taking the majority of the orders recently. So you'll hear some howling from them. I think you already heard some howling from United CEO Kirby, right, on the MAX 10. So I think that's what's going to happen. You'll just see deliveries get pushed out and pushed into next year. Hopefully Boeing can recover that and bounce to higher rates. That's all about their recovery.
So, I mean, the Boeing stock is off 5.8% today on the news, off 22.5% year to date here. So the street is really concerned, George. I mean, is there I just kind of feel like they're kind of too big to fail. They're too big for anybody to really do anything because it's a duopoly, them and Airbus. But are there what is it, like a downside scenario here for Fox? Would it be government regulation? Would it be, what's kind of spooking the market?
Well, I think you already have part of that downside, right? And that's more intense government oversight and regulation. Frankly, that probably should have occurred anyways. You know, the FAA is also going through some difficult times during the pandemic, lost a bunch of personnel. They need their skill sets developed, sharpened. So this process could be slow. But I do think I think they are close to too big to fail, given that they're such an important government contractor. One of the few big primes that can make airplanes in serial production. Mm-hmm. Question is, what could the government do if they had real big problems on the commercial side? I don't think we're there yet, though. I think it still is a duopoly. If you wanted to get in the back of the line for an Airbus A320, the competitor right now, if we just add up all the orders they have and their production increases, you're out 8 years. And I think some of those orders are definitely long-dated orders. So maybe if you got in the back of that line, you'd be out 5 or 6 years before you started getting airplanes. That alone is going to keep folks going towards Boeing for airplanes. Yeah. But that's only if things don't degrade from here. If things degrade from here, you got a much bigger problem.
George, we have like 40 seconds, but for an airline that was supposed to get a plane that's not getting it, do they have other planes that can suffice for them, or are they going to be in the hot seat?
So I think you're going to see the airlines holding on to their older aircraft. If they have older aircraft, they'll fly them longer. It's been good for the maintenance business. If they don't, they'll have to shut down some of their schedule and not fly as much. That could help the U.S. airlines in 2024.
All right, George Ferguson, thank you so much. We appreciate that. George Ferguson, he's the Senior Aerospace, Defense, and Airlines Analyst at Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One of the big drivers, as Nora was just reporting, was IBM, our good friends in Armonk, New York. Great headquarters, by the way, up in Armonk. The stock's up big. I mean, it's close to an all-time high. It's at a 52-week high. I want to break out what's driving our good friends at IBM. Anurag Rana, he joins us. He covers technology for Bloomberg Intelligence, and it turns out he's pretty good at it. Anurag, you've been following Tesla for a long time. Give us the bull case for Tesla right here. The market really seems to like what they saw in the earnings last night.
So for IBM, one of the biggest things we talked about yesterday was the free cash flow number came out at 12 billion. I think we were slightly above the street and saying that, I'll be happy if they do 11 billion. So I think that really speaks both to the organic growth rate of the company, operational efficiencies, improving margins, taking care of accounts receivables, all sorts of things. So I think it's really good print for IBM in terms of free cash flow, but also the guidance on the organic growth rate, because we were going in. So in fourth quarter they did 3% growth rate in constant currency. We thought at least for the first few quarters they're going to talk about 3 to 4% and then accelerate, but they straight away went with a mid-single digit number. So I think overall good for IBM, good for the rest of the tech space. I feel pretty happy about it.
What I know this is kind of probably a dumb question, but like what in IBM's business model to a Luddite like me are they doing well? Like break down the different categories in a way that makes sense to Alix.
So they still are a very big piece of the entire tech ecosystem. They have very strong relationships. They have a good consulting business. They have Red Hat. They sell mainframes. Now, remember one thing. I know people getting very excited, but if software spending is climbing between 10 to 12%, IBM's still growing, 6 to 7. So they're still underperforming the entire broader software space. But that's okay because, when you go from 3 to 6, that's a big change also in terms of the growth rates. This is just a matter of overall tech spending improving after 2 years of underinvestment. This is something that we have been saying for so long. Tech as a portion of total GDP is a very small number. Most of the companies around the world, barring the consumer technology companies that we see, have underinvested in technology. So when you have rail companies or airlines or auto insurance companies, they really need to be more digital. And one way to get digital is to move a lot of their infrastructure to the cloud. So all of those things play in well. We have not seen good spending in 2 years. I'm pretty happy that 2024 we may see a rebound.
So, Anurag, how does IBM fit into the AI discussion? Because I know the CEO called out the client demand for AI is accelerating. How do they play in that space?
So majority of the stuff that they're going to do is on the consulting side. So if you are a large company, you need to figure out what to do. They have a lot of consultants that can help you clean up the data, use whichever model we want to use. You want to use something from OpenAI, Anthropic, all these companies that are out there, they'll help you with that, help you train the models, and then at the end of the day, you make it for your business case. It's not as easy as just, using ChatGPT and answering questions. For an enterprise use, you need to do a lot of data cleanup, data aggregation, because that's what's needed to clean up your, the models itself.
How fast and long can that kind of growth rate of 6-7% go?
I think if this year they are able to go to 6-7%, I could expect then, another 100 to 200 basis points improvement next year. And that's actually not a bad deal, because you remember the old IBM just about 4 or 5 years ago, they were not growing at all. So in order for them to actually come up with a high single-digit number next year would be really welcomed by the market.
So what's the read-through here, Anurag, for greater tech here from IBM? Can I say I'm just going to go out and start buying more of these names? I'm looking at like NVIDIA, for example, up 1.5% today, up 25% year to date, and of course up 220% over the trailing 12 months. I guess this is a pretty good read-through. Can I do that?
Yeah, so we had run a CIO survey back in December, and we kind of got the indication that it's going to be a year of spending more aggressively compared to the last two in 2024. But the way we had built that, and we got the chip strength going on right now that probably carries on till the summer, and then after that we see strength in the software and the consulting area, which are more of the downstream play. But it's possible that we may see that bounce back as early as second quarter or going into it, because things I think the leading indicators are good at this point. Mm-hmm. So I'm pretty optimistic that when we were thinking about a second half recovery for tech spending, it may actually happen in second quarter or maybe even as late as first quarter.
What are the derivative plays from IBM? Their suppliers, that kind of trade?
Yeah, so you have, companies on the services side. You have companies like Accenture, you have Capgemini in Europe, you have TCS and Infosys in India. So those are the 4 big ones for the consulting side. On the software side, I think this bodes well for everybody, whether it's, Microsoft, AWS, ServiceNow, Salesforce, Workday, the big software vendors, all of them should see some downstream effect if tech spending does recover this year.
All right, let's preview Microsoft here. I mean, again, the stock just hit a $3 trillion market capitalization, which got a lot of people's attention. What's kind of the story here for Microsoft?
Yeah, I mean, it's a very similar story. We recently published a piece today which says, there is going to be a bigger delta between Microsoft and Apple's growth rate going forward. And a large portion of that is an improvement in the cloud and the other product growth rate in the second half. Now, if you look at the Bloomberg terminal and look at the function EM10, you will see that Microsoft growth rate has picked up for the next 4 quarters, but majority of that is because of the Activision deal. If you peel through that and look at it, organic growth rate, Street is still expecting that 11 to 12% over the next 4 quarters. We think that's going to change. We think the second half that growth accelerates to 13% or so, and that's because of the reasons that we mentioned above. That after 2 years, companies are finally spending, and one of the things we saw was, if you have a cloud business infrastructure, then you can reduce your usage because that helps you reduce your costs. And that's what a lot of the companies have done over the last 2 years. We think that's going to take a reversal this year. On top of that, Microsoft should get more benefit of their relationship with OpenAI because they are OpenAI's back-end infrastructure. So I think that's also contributes. So we are expecting growth rates to pick up for Microsoft in the second half.
IBM trades at 20 estimated times PE, and you're taking a look at Microsoft trades like 35. Are these accurately valued here?
I think it's a very tough question to say because, frankly speaking, I do not know if IBM will ever catch up to the software industry growth rates because they have 2 units in there that, may be able to bring it down. But Microsoft, one could argue, being almost 1/3 of the software market, such a big company, it's still growing 12, 13, 14%. That's a pretty big number, and you can't really say that about any, large tech company in terms of high gross margin and high growth rate. It's very unusual to see that.
All right, Anurag Rana, thank you so much for joining us. As always, Anurag Rana, Senior Technology Analyst for Bloomberg Intelligence, coming to us from the technology capital that is, of course, Chicago, Illinois.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Looking at Tesla, stock's down 10%. For most companies, that would be tragic, but this is like just an average day for the volatility of this stock over the years. But again, some fundamental concerns coming out of the earnings last night, and that's where we want to start in the tech space today. And we can do that with none better than Dan Ives, Managing Director and Senior Equity Analyst at Wedbush Securities, joining us live here in our Bloomberg Interactive Broker studio. So Dan, thanks so much for joining us here. With Tesla, and it's not just a Tesla story, it's an EV story. There's real concern in there about end-of-market demand for EVs. Did Tesla help itself last night, or maybe not so much on that particular issue?
Look, I think it was a train wreck conference call.
And is that a train wreck Elon Musk?
Yeah, I mean, isn't it always in some ways?
I would call this just a train wreck conference call, even for Musk. Because the problem here is that it's actually not even so much the demand issue. It's about the price wars. And not giving guidance, not giving strategic goalposts. Look, the dream, AI, we're huge believers. Disruptive tech, where this is all going. But in the near term, when the plane's crashing, people are not focused on salted or unsalted pretzels. And that's the problem here that's happening on that call because of the price wars in China.
Well, did Tesla miss a trick by not spending more money making a cheaper car?
No doubt. I mean, if ideally right now we'd have a sub $30,000
Yeah, exactly.
car. But
instead we have a Cybertruck that no one on city street can park.
Look, I mean, but that's one of the balances because they have to also go innovative, high end. You can't just be low cost. And the technology here, it's taken time. I mean, you really had to have a Mexico facility. You have to build out Austin in terms of from a gigafactory perspective. They're doubling down on EVs, where Detroit and others are peeling back. Yep. No one argues with the strategy longer term. But from an investor perspective, a lot more questions and answers. And that's why I think it was a little bit of a black eye last night in terms of a call from Musk.
So where is the company in terms of communicating the real on-the-ground situation in China? what do they really think China can be for them?
Look, Tale of Two Cities, the demand side, I think actually stabilized to, they've gained some net share. Clearly, BYD is really the formidable competitor there. But then it comes down to the price war. And that's the crux of everything.
Is there a price war just in Japan, or are we talking kind of globally here?
I'd say globally,
Okay.
but the heart of the price war is in China.
Okay.
And with price war, you've already had prices come down 20-25%. You wanted to see last night a line in the sand. Okay, we'll cut around the edges, but we feel like most of that's in the rear view. Left a door open, and that's the frustration
Yep.
here. This is really more of a margin declining story rather than a demand falling off story.
I gotta say, Dan, this sounds like you're a little bit cautious on Tesla. I always think of you as like the tech bull. Like no matter what, you get to find the silver lining. Like this feels like a big moment.
Look, I think I'll call it's another inflection point where we've had over the last decade periods where back was against the wall. How are you going to perform? And this is another one of those. So the long-term, to your point, the long-term story, decade long, it's there. But also, you can't be smoke and mirror, right? I'm not going to wear the rose-colored glasses saying that this was a great conference call. I mean, if you looked up in the dictionary, disaster right now,
Well,
there'd be a picture of that conference
Well,
call.
I think the analysts on the street reflected, Alex. I mean, you look at the ANR function on the Bloomberg terminal for analyst recommendations. There's 22 buys, 24 holds, and 12 sells.
But this also raises the question, and I got some grief on this yesterday, but like, what is Tesla? Is it a car company? Is it a software company? Is it a tech company? And then how you value it. So if it's going to be a software company and an AI company, maybe it's okay. But if it's going to be a car company, then you can't value it the way it is. Like, how do you even start to price all that in?
Yeah, and we've always viewed it, and we talk about a lot on the show, disruptive tech.
It's all of it.
And that, and it speaks to where I could argue, like, this could be a trillion and a half market cap as it goes through on AI and the vision on EVs, especially as they double down. But as they go through this interim period, Musk talked about they're in the middle of two waves, and that's essentially where they're caught. You cannot keep giving up margins. You start selling Gucci sunglasses for $100 at CVS, you're not selling them for $2,000 in Madison Avenue. So the problem is that it's a margin story. That's the issue right now for investors. You need guidance. You need an adult in the room. And instead, it felt like more like preschool.
Well, that's kind of what, of the people that aren't recommending the stock, most of them are traditional auto analysts. And they know it eventually it gets down to bending metal. And the bending metal business is not a great profit business.
Sure. And I think we've seen that in the 313 area code as there's the transition to EVs and everything that GM and Ford have gone through. But Paul, to your point, like it is disruptive tech.
Yep, totally.
It is, but this is a little white knuckle period right now.
All right, let's broaden out to other tech because like IBM, awesome. Microsoft, $3 trillion company. Like, I mean, the old school, what did you call them yesterday? The boring?
Yeah.
Like
old school tech.
Like the old school tech. So hot right now. Sustainable? What do you think?
The AI revolution's here. And we've talked about the new tech bull market, which we talk about starting in the fall. We believe this goes well in 2025 because it's the biggest tech transformation in 30 years since the start of the internet in 1995. So when you look at IBM, you look at SAP and some of the others, they're going to benefit from this. They're clearly leading this. Is the godfather of AI, Jensen and NVIDIA, and of course what's happened at Redmond with Nadella, which is why I believe in a year from now, we're talking about $4 trillion market caps with Microsoft and Apple. And I think that's why next week, you look at Apple, you look at Microsoft, I think that's really going to be an eye-opener for a lot of those bears that maybe they came out of hibernation mode a little the first week or two of the year.
Yep.
I think it sends back into the caves.
When we think about AI, that's clearly the long-term, intermediate-term, longer-term growth driver for just all things tech, I guess. My question for smart people like you is, how much of that spend do you think is going to be incremental versus maybe just pulling out of my IT tech budget or something like that?
Yeah, I probably think about 50 to 60% of it is incremental. And I think that's the difference.
That's big. Yeah.
Is that when you look at the incremental use cases, it's jaw-dropping. And I think that's why CIOs are recognizing the process and actually the ability to use software. And we think use cases right now are over 80. It was 15 use cases 6 months ago.
What I also find interesting about this is that this is a structural shift in the industry, yet it's still a cyclical industry. How do you know what an appropriate valuation is looking at that? Like, this is going to be huge. This is going to spend all the money. But hey, in the short term, maybe there'll be a downturn.
Well, I think a lot of the DCF spreadsheet warriors, what they can find in their 10th floor of their office building in the spreadsheet is where growth's going next 2-3 years. So I think
that they don't know.
And that's why we're boots on the ground trying to understand like what the growth looks like 2-3 years out. Then you could start to have a better sense incrementally what these stocks are valued at. I still think numbers for tech, we sit here, I think numbers for tech are up another 12, 15, 20% over the next 12 to 18 months, not just because of the efficiency, but because right now a lot of these models, I think, very conservative relative to how they're laid out.
So as you sit here, what's your top pick right here, Dan?
Oh, it's Microsoft and Apple. I mean, to me, Microsoft as a cloud play, Apple, I continue to think that's probably the top tech pick here, especially on Renaissance of growth. And then you look at cybersecurity. It's a golden age for cybersecurity. You look at names like Palo Alto. And for those looking for SMID cap, the Messi of AI, that's names like Palantir.
Okay.
What don't you like?
Look, so I think
most hated, 30 seconds.
I mean, most hated is Cisco, just because I think they're a shared donor. And I think that you're going to continue to see the legacy be share donors. Software are going to be the share gainers.
All right, I'm just going to quote from Dan's research note on Tesla. We maintain our outperform rating while lowering our price target from $350 to $315, reflecting reduced estimates. Our near-term confidence in the story is shaken, but we remain firm on our long-term bull thesis around Tesla and the broader AI story set to take hold. This is a pivotal period for Musk to get Tesla through what will help shape or haunt its EV future.
Category 4 hurricane.
There you go.
These are serious statements.
All right, so
Dan
check
Ives.
out Dan's research out there
Great
from
stuff.
Wedbush Securities. As Tom Keene likes to say, we protect the integrity of our research. Dan Ives joins us, Managing Director, Senior Equity Analyst for Wedbush Securities.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix, let's talk sustainable energy, actually investing in sustainable energy. If you remember back to the Inflation Reduction Act at the time, back in mid-2022, a lot of folks were saying, boy, this is going to be huge for sustainable energy investing. One key investor is like, I'm not so sure right now. Charlie Donovan joins us. He's a senior economic advisor at Impax. Charlie, you're a part of a story on Bloomberg that January 15th that says a $50 billion investor says Biden's green law enriches middlemen. What's going on there, Charlie?
Well, as you said, the Inflation Reduction Act in 2022, a lot of high hopes and clearly a necessary move in order to reclaim leadership in a crucially important industry. But we have seen the implementation, quite honestly, be disappointing. And a lot of that goes to the complexity around relying upon tax equity as the major channel with which new projects get done. And there are alternatives. There are other ways to do this. So we really see right now that the technology is in the right place. The economics are increasingly in favor. But there are a number of ways in which the implementation of the IRA has proceeded more slowly than investors would have liked. And certainly the complexity doesn't lend itself to a scale at which what is really trillions of dollars of new money that can flow into infrastructure can do so at the pace that's necessary.
I mean, you're basically saying that a bill passed by the government in some ways is inefficient. So I get that. However, if we take a look at just GDP today, like within that, the contribution of business investment, you can make an argument that did reflect energy projects. And also the idea of the IRA is that it is a 10-year thing. So just because you're not breaking ground today doesn't mean you're not going to be breaking ground in 3 years.
Well, that's exactly right. And also we see a canvas across a value chain in clean energy that is much more expansive than just thinking about solar and wind manufacturers. So we think about it in an area where there's upstream, just like there is in oil and gas, where that's the production. But you have a much, much bigger set of companies who are involved in what we call the midstream. So this is transmission and distribution. It's about storage. And then downstream, which is really much closer to the consumer and reflects the changes in which electrification of end demand is happening much more quickly than people thought. And there's a huge number of companies who are benefiting from the stimulus in more indirect ways there. And so it's really important to keep in mind that, as you say, although certain projects are now in the pipeline, have been announced, will take some time to come through, there are another number of other ways in which investors can play this structural theme in the years ahead.
So I guess green. Oh, thank you for the little button there, Ken. Green investors.
Oh, it's not just me.
No,
Oh,
no,
good.
no.
I always
I've only
forget
been
to
doing
turn
this
the
for
little
4 years.
on button on.
I know. You got to push the little button.
I'm new. This is day 3. 4?
This is only year 4 for me. Tucker's been doing this for 30. All right, so talk to us about the investment returns that green investors have been dealing with. Not so great here, and if so, why is that?
Well, I think it's important to keep in mind this is an industry that has been around for, a lot of people think of it as new, but it's been around for a while. We have had a number of really important waves of interest and investment, going all the way back to the late 1990s. A lot of what we see in hydrogen today, for example, are companies that had their IPOs in the late 1990s. So there is some cyclicality here, and there are going to be times at which sentiment is more or less in favor. What's different now is that we have lived in the last decade through a technological miracle in which the technologies that enable not just more green energy, but actually a global energy transformation in which electrons become the backbone of the energy system and begin to increasingly replace hydrocarbons. We are on the cusp of something that we've never seen before. And that's really about where technology costs have gotten to. It has certainly something to do with the policy environment. It has something to do with what is able and the innovations that have come through that drive to make this more accessible and cheaper for consumers. So, there are going to be ups and downs, as there are going to be in every industry. But I think it's important to keep in context with these previous waves and these previous areas of interest, what's different now? And that fundamentally comes down to the economics of these technologies.
I mean, sure, but I gotta be honest. Like when I talk to clean energy players and even hydrocarbon companies, they like these tax credits. Like they dig them and they're in deep with them, and that's making a lot of these projects economics. Like I hear you that the cost of technology is going down, but without certain parts of the IRA, their economics are toast when it comes to this, and these are like $1 billion worth of companies.
Absolutely, and in what we have said and what we have written about is that these are appropriate ways in which to stimulate its industrial policy writ large, and it really is about the jobs and the inward investment that's going to happen in the future, which industries and how is the U.S. and particularly U.S. companies positioned for that. What we have tried to call out is the complexity about how we get there. So it's not, when you look at the more broad canvas, and the IMF has talked about $7 trillion last year of subsidy into the oil and gas industry, we still have an unlevel playing field. And so that's why this kind of stimulus is necessary. So it's not the reason for stimulus, but it's much more about the mechanisms for implementation that we're trying to shed light on, because we see such a vast opportunity, and we see how many investors are seeing just such a thin slice of this opportunity, and clearly trying to just call out that there are a number of other ways in which this can happen, and there's a much bigger value chain there that can be invested in.
Hey, Charlie, let's step away from the Inflation Reduction Act. I get a sense, and it's just a sense from an outsider, that kind of the move to green energy is stronger, let's say, in Europe than it is in the U.S. And some are saying it's maybe getting a little politicized here in the U.S. You can't even say ESG anymore in many parts, with many parts of the audience. How do you view that broader sense in terms of support?
Well, there's clearly, Europe is more vulnerable on energy, and so there's a very natural reason why that's the case. And clearly, what we see is, on the policy side, much more aggressive implementation of targets, much more national priorities with regards to both energy efficiency and clean energy itself. But I don't think that any country in the world is not touched by what is really now a competitive race for positioning in what is going to be inevitably a cleaner energy future. And that comes down to not just cleaner, but also cheaper. And so, again, coming back to the point that, yes, green energy is one way to describe this, but actually the energy of the future, I think, is a much more viable way to think about it. And in that sense, the U.S. has been asleep at the wheel and really has ceded a lot of early technology leadership to companies in China. And this is European companies as well as American companies are scratching their heads and figuring out how do they get back into the driver's seat. And there are some stunning examples of companies in Europe and the US who have that advantage, but that is not a very deep bench. And in a lot of ways, that's what needs to happen now, is for those companies, whether they're European or American, to find a way to become competitive in this race.
All right, Charlie, we got to leave it there. Thanks a lot, Charlie Donovan, Senior Economic Advisor at Impax, on issues really investing sustainable.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.